Hi, I'm James Callad, retirement educator with Bell Bank Wealth Management. In today's Your Retirement Toolbox video, we're going to be looking at different types of investments and how they work together in a diversified portfolio. The major elements of any portfolio are stocks and bonds. Stocks represent a share of a company, while bonds represent a loan made by an investor to a company or a government entity that pays the investor fixed income. Stocks and bonds have different pros and cons. For example, stocks have historically had a much higher growth rate compared to fixed income investments like bonds, but they also come with more volatility and fluctuation in value. Bonds, on the other hand, offer timely and predictable income to your portfolio, even though they don't provide the same growth as stocks. Let's look a little bit more closely at stocks. Because stocks can swing widely on any given day, they add an element of risk to your portfolio, but it's important to stress that the longer you hold on to an investment, the less volatility you might experience over time. This chart shows the range of returns for stocks, bonds, and cash over a 1, 5, and 20-year period. On an annual basis since 1926, the returns of large company stocks have ranged from a high of 54% to a low of negative 43.3%. For longer holding periods of 5 or 20 years, however, the picture changes. The average returns range from 28.6% to negative 12.5% over 5-year periods, and between 17.9% and 3.1% over 20-year periods. Holding stocks in your portfolio means you might experience short-term swings in value, but over time, that risk decreases. Now that we've discussed how stocks and bonds work, I want to cover why it's important to have both types of assets in your portfolio. This is called diversification, giving yourself exposure to or investments in a mix of stocks, bonds, and cash. Because stocks and bonds react differently to market and economic events, having both types of assets in your portfolio means you would experience less severe market fluctuations than if you're only invested in either asset class. This chart shows how a diversified portfolio saw smaller swings than stocks alone during major economic downturns like the 2007 to 2009 bear market. It's important to remember, though, that even though diversification can reduce volatility, it doesn't mean you'll eliminate all risk of loss. Your portfolio's specific allocation, what percentage you have in stocks versus what percentage you have in bonds, in other words, will depend on your age and how comfortable you are with risk. If you're younger and have decades to go until retirement, your portfolio may be more heavily allocated towards stocks to take advantage of long-term growth opportunities. If you're closer to retirement, a more conservative portfolio that relies on predictable income of bonds might be more appropriate. Talk to your retirement plan provider if you have questions about your portfolio's allocation. I hope this video helped you understand how a diversified portfolio can be an important part of your retirement toolbox. Thanks for watching, and be sure to check out the other videos in our series.